Welcome everybody to our first panel, MiFIR, How to Get the Balance Right. And let me briefly introduce our panel in alphabetic order. So we have Niels Raab online, Head of Group Regulatory Strategy and Chief Regulatory Officer of Deutsche Börse. We will have Professor Hübner, who has to leave a bit early to attend a hearing in Parliament. And Professor Hübner is member of the European Parliament, a former commissioner, and I think since 2009 in the Parliament, and more pertinent to our debate, she is also the rapporteur of the MiFIR file. Then we have Phil McIntosh, Senior Vice President and Chief Economist of NASDAQ, who can certainly shed a light from the US perspective on market structure, consolidated tape, etc. And next to me is Alžbeta Pasterková. She is the chair of the Council Working Party on MiFIR and in the Czech Finance Ministry, and obviously also very involved in the file. And let me just maybe give a few thoughts as an entry to the panel. I think if I look at Spotify, BioNTech, Linde, who have all decided to turn their back to European capital markets, it's very often liquidity what they cite as the reason to go to the US, and Phil can maybe comment on that later on, but I think they see liquidity and valuation in the US are much better than in Europe. And if we look at the last 20 years, it seems Europe is losing out to Asia and the US in terms of capital market development. Our share of market capitalization as part of the global GDP is going down, and it seems companies are looking to go elsewhere. So certainly MiFIR is probably one of the core things to look at to be competitive. It is the European Constitution and the framework we give ourselves for capital market when it comes to transparency, integrity, and fairness. And I think that's very much what Jela was alluding to. Investor trust at the end of the day is key, that I think the optimal price is found and that capital is allocated to the most efficient use. And as such, I would claim MiFIR is very much at the core of the capital market union. Without efficient capital markets that investors can trust, I think a capital market union will not be successful. So for our panel, it's a little bit the question to ask, how do we get that balance right? How do we make MiFIR work? What market structure do we need to choose to be competitive again? That companies don't say our markets are not liquid enough to stay in Europe. How can we encourage more lit trading, or is it better to actually move to a dealer market model, which I think is more the UK example? Should we ban PFOF, or should it be the new default for retail trading? What role does the tape really play in that? Is it something that helps in transparency or allows new business models that maybe are an unlevel playing field? And how is it really linked between market structure, best execution, good outcome for investors? What role does the CT play? So I think a lot of very interesting topics to cover. I would maybe ask first Alžbeta to give us a little bit a status of what's being discussed in council and where we stand, and then followed by Danuta, who will tell us about what is being discussed in Parliament, and I think then we'll enter into the debate.
Good afternoon. It's a pleasure to be here. It's a very interesting question, how to get the balance right. Let's say that we have been trying to find the answer in the council for the last couple of months, and we are still looking for it. Hopefully in the end we get the balance right, but the question is where it lies. The council is the constellation of 27 member states, and the compromise is always there. The compromise is what is agreed between member states as the way forward. So that's the situation we as a presidency trying to follow and trying to reach the compromise among the various opinions of member states they have. I would start with a market structure and so much famous double volume cap. It has been proposed by Commission to drop double volume cap, and Council has a problem to agree in MiFIR on almost anything, but they can agree on that the double volume cap costs much more than it's worth. So there is definitely agreement that we need to move beyond double volume cap in a market structure for equities. The question is what should replace it, and that's kind of harder to find. There is debate and potentially also situation for single volume cap. Of course, then the question is what would be the cap and what level should we set the balance. And based also on the new proposal on in UK on a wholesale market structure revision, there was a proposal, and we have also put it on the table to remove a cap altogether and propose to have more open market with potential powers for Commission to step in if the dark trading would overflow or reach some certain limit that would not be acceptable. So we are balancing in a council between more flexibility and to more allowing markets to actually show what is capable of or not, and about having a single volume cap at the moment. I would say the discussions are still ongoing, so I can really tell you where we land, because this will very much depend on the majority of member states. As for the SI regime, French have found some kind of balance on regulation, yet again, based on the UK proposal, the member states have tended to be and required to be more lenient and more flexible in the upcoming not easy times, as was mentioned a couple of times here today already, that Europe will be facing more stringent, more strength on liquidity, and more flexible regime might be more appropriate to address what is coming in a way. But again, that is still open for discussion, and we still don't know where we exactly land on this. And then there is the debate on never ending and never decided PFOF. As you all probably know, the Council has ended up in a deadlock. And the PFOF, we're having a blocking minority on requesting for PFOF and having strong majority on being very advocate for the ban. So we are in a very intense debate in the Council to find a potential solution. For sure, I can tell you that we are trying to build a solution on what is already in a MiFID. So we would very much not like to deviate from the concept of best execution as is in the MiFID, which constitute of a price of financial instrument as well as a cost of settlements and so on. So we are definitely trying to build on that. The idea is to have a limit on what is considered to be appropriate price of financial instruments, and the arguments are tending to be in the spread of EBBO. That would be potentially or maybe included in the consolidated tape. And of course, then there is a question whether, and again, member states tend to agree that there is reason to limit a cost as well. So there would be a guarantee for the retail investors to have actually, let's say, the best possible execution in Europe. That much from my side.
Danuta, do you maybe want to comment, Professor Hübner, from the side of the Parliament?
Yeah. I hope you can hear me, right?
Very well.
Yes. I even hear myself twice. Yes. So it's thank you very much for reaching out also to the Parliament. And I could start by saying that we have 705 members and 8 political groups and 27 national interests. So it is, like in the Council, also extremely difficult. And we have started already now the discussion at the political level, so we are probably much beyond or behind, rather, I should say, the Council, but we are waiting with a lot of interest on where the Council is moving with individual issues, which are also very important for us. We also have the amendments that were tabled in mostly focusing on consolidated tape, the market structure and transparency, and also the best execution. We have started already negotiating the compromises. We had the first meeting on the compromises, and I think we are largely sharing the starting point and the general objective of this review of MiFIR. I think we are fully aware that this comes in a time, at a critical time for Europe, and that I think we all know that Europe has no other option but to get a bigger, stronger, more competitive, more unified respecting level playing field with simpler rules, capital market. Otherwise, I think we will fail also with all the big ambitious programs of investment we have. We also understand fully that in the current context, we have to look at other jurisdictions. We should not be rule takers, of course, and we should not engage either in a race to the bottom or to the top, depending on the perspective. But we should probably spare no efforts not to make the situation worse and penalize the EU capital market participants with our rules that would not be sufficiently conducive. So we have this feeling, this burden on our shoulders with us all the time. But we are also fully aware that Europe has a wide diversity of market participants, that also the measures that we will put forward should not create a situation where capital would go away from the union. We should rather create really an attractive environment. That we also agree. We also believe that this is the time where we should consider giving enough powers and flexibility to ESMA as European supervisors that could take decisions based on data, which is one big issue not yet mentioned, and also that can adjust the framework based on market evidence and also market changes. So this is the direction we would like to take. And the file is, of course, very technical, but it's also strongly political, I would say. And we clearly see that there are different national sensitivities in this file. There is also this big challenge that we have been always lagging behind the jurisdictions such as the US, or we also compare ourselves now to UK. And the conclusion we have from that is also that we have to increase the competitiveness of European Union capital market. And we have to cope with all those differences between capital markets in different member states. And there are in some parts of Europe, I was thinking specifically about Nordics on some issues where we have also a lot of good examples that we could use. So we today, I can say that actually nobody among those who negotiate questions the introducing of the consolidated tape for reasons which are important to identify, I think, because that then act on the different measures in different areas that will influence the functioning and the role of the consolidated tape. So we see it as a price comparison tool, and we also, which we lack today, but we also hope that it will be done in such a way that it should reduce, that it would reduce the cost of market data, which are, I think, often today hindering a lot of developments in capital market and financial markets and in other markets as well. We also see as a shared objection the strengthening of the EU lit venues. And we propose to do it through reviewing upwards the thresholds for the use of the reference price waiver. Also review upwards the thresholds for SIs activities, and also addressing the issue of PFOF, which is a practice actually that can reduce the retail flow going to lit venues. And then we largely share across the political groups also the need to empower ESMA to calibrate all those measures. And if we have the ESMA on board, this would ensure that the thresholds and rules can be adjusted if market changes and can be also implemented with the support of what only ESMA has.
No, I could not hear her, but
from the markets. We also agree that if we manage to simplify, we are not very successful in the European Union with simplifications, but simplifying the current transparency regime, which has proven already, I think, to be too complex and too burdensome, by harmonizing the deferrals regime for non-equities, or proposing also to suspend what Madame Pazerkova mentioned, the double volume cap, which I think proved to be arbitrary and ineffective. So the simplification is important because hopefully it would reduce also costs, and it would produce also incentives for the greater participation. We, of course, regret that we cannot because we talked about it as well in the parliament, we cannot use the MiFIR to go beyond the MiFIR review and, for example, to cope with the integration or with the need of integration of the trading and post-trading infrastructure. As today we know that the costs to trade set clearing are very high when we do it the way we do it. We hope that the review of listing rules will also come next year and will also incentivize more companies to trade in Europe. And I also hope that we will have a revision of the fiscal rules around equity ownership. Whether going back, just for the last sentence, going back to this other jurisdiction issue,
Thank you.
Was asking, I think you can always learn from others and you should learn from others, but to see the unified, very different jurisdictions as the right benchmark for European Union solutions, here one should be very careful. I think we are not a unified jurisdictions. Unfortunately, I must say it will not come tomorrow either, and there's a lot of specificities which we need to consider, and we should see the other jurisdictions what they are actually. They are competitors in terms of attracting capitals, and especially the American market is a universally extremely attractive, and it's also a global reference point in terms of attractiveness and the overall size of the capital markets. I hope our size will also grow. So what I think, therefore, just to finish, is that changes when we talk and when we will be introducing the agreeing on the changes to the European capital markets in Europe, we should always consider the international competitive environment. I think this is fundamental, and that's why when we look at UK, when we look at the US, we can learn a lot. But first of all, we have to see that that's our competitive environment in which we also should one day maybe should be more winner than loser. That would be my introductory remarks. Thank you. Probably I should say we are planning to finish the negotiations by the end of January. So if the Council is done by that time, we could then quickly move forward.
Perfect. Thank you. Thank you very much, Professor Hübner. And I would maybe give the floor to Niels Braab. Niels, and maybe for the structure, I would, in the first part of the panel, try to discuss equity market structure and then later on move to the tape. So we have, I think, the two debates maybe a bit separated. And we just heard from Yeller, I think investor trust is important. Professor Hübner and Elisabetta stressed that really competitiveness is important. If I look at the reality of, for example, Deutsche Börse, Linda has said they're leaving to the US. How do you view competitiveness? Who is actually in market structure the competitive benchmark that maybe you need to aspire in terms of liquidity, in terms of competitiveness, and how do you view the equity market structure in Europe, you know, lit versus dark, PFOF, systemic internalizer? Is that a good starting point, or what do we need to do?
Yeah, thank you very much for that, Rainer. And let me also start by wholeheartedly thanking Professor Dr. Hübner and Ms. Pastakova for taking the time in their extremely busy schedules. That's really much appreciated to have an important exchange on the ongoing MiFIR review. I will indeed, Rainer, as you mentioned, first and foremost, jump a bit into the market structure reflections before then happily tackling the consolidated tape conversation in the second part. I think that Europe is sort of standing at a crossroads is very clear from the global perspective, right? And I think that's always a key reminder to all of us. We see extremely high levels of inflation at the moment. We see very much so constrained public finances and heavy and high debt levels in light of many of the emergency measures that had to be done the last couple of years, be it around COVID or Ukraine. And I think this is being paired, of course, with this monumental financing need that we see, especially also in light of the digital and sustainable transformations. So that leads us to assume that capital markets will continue to be absolutely critical for the future of the European Union. I think we are all very clear that the endeavors over the last 2 decades have not necessarily rendered the benefits we wanted to see in the markets. And when we look very concretely then at at the MiFIR discussions, this is, of course, as Rainer alluded to it earlier already, the sort of heart piece of the European Union's securities markets legislation. And as such, of course, the ongoing review gives us a great opportunity to target the framework more to the current needs of the equities markets in particular. If we look into some of the key proxies, however, I think it's also important to remind ourselves where we stand in terms of total IPOs. We've seen 2,700 of those last year globally. 60% of those went live in the US and Asia. Only 12% went live in the European Union. When we look at market cap, for example, the US market is standing at above 190% of their GDP. In the EU, we manage only about 50% of the GDP. But even more so, we have some critical indicators. Rainer just alluded to it. EU companies are moving abroad. We see that the EU equity markets are increasingly seen as unattractive. And in Germany, we've just basically seen the decision to delist from our stock exchange in terms of Linde, which is the biggest company in the German index. But I think it's also critical to not lose sight of the citizens' reality in terms of participation and ownership. When we look, for example, into the German DAX, we see only that 12% is being owned by the Germans themselves, 40% is owned by US investors, and about 20% by UK investors. And finally, to finish off on a very sort of dark and alarming picture, we see especially this year, a very, very pronounced outflow from EU equity markets. In the first half of this year, this was about 31 billion. That's the highest in many years. I think last year in 2021, all of the outflow combined was only about 3 billion. And at the same time, we see a strong inflow into the US markets and partially also the Asian market. So starting from that benchmark, I think really important to reflect on the MiFIR market structure discussions, where we want our markets to be and how we want them to perform. I think generally speaking, when we look at some of the sort of main objectives that MiFID II and MiFIR had when being introduced in 2018, especially around transparency, it seems that we've not fully delivered on what we promised. I think that holds generally true as an observation across all of the asset classes. Is of course traditionally more pronounced also in bonds, where we see an extremely intransparent market picture as such. But on equities in particular, I think it's important to remind ourselves that more than 200 systematic internalizers have been created with the introduction of MiFID II in the course of the last 4 years. And also, when we look at the actual market share realities, we see that the SIs are nowadays coming in with about 27% of the total market. Exchanges are only coming in with about 28%. So it's pretty much on an equal footing. But the key point for us, of course, to highlight is that there is no fair competition in the market as such, right? Because the systematic internalizers of this world run under very different and specific regulatory requirements, which is not the same case for the exchanges. And that's also, I think, getting even more problematic when we pair it with the latest observations in the markets, be it, for example, around payment for order flow, where we see de facto a sort of institutionalization of conflicts of interest. So if I look concretely then into the sort of outlook and what we believe would be critical to obtain, and that also goes back to some of the important points made by Ms. Hübner and Pazdakova. I think on the dark trading cap, I would fully agree that the double volume cap hasn't functioned and was a pretty meaningless instrument under the current MiFIR framework. The question, though, for me would be, is it then the right approach to delete the dark trading cap if in the first instance it sort of hasn't rendered the results that we actually wanted to achieve? I personally believe that the Commission has made a solid proposal by proposing to introduce a single volume cap, which we very much support. We believe this should be tweaked slightly, however, to first and foremost include really all of the market. I think even in the drafting of the European Commission, not everything would be captured, and we see in particular the need also to be sure that a single volume volume cap would capture systematic internalizers and also frequent batch auctions, which could, of course, be the big winner of some of the currently discussed reforms. I think the other key element for me is really around the SI regime in itself, where we would believe that it would be important to establish an authorization and monitoring regime. That's definitely, I think, a good starting point to making sure that the regulatory parameters are being complied with. But it's certainly also needed, and we come back to that later in the debate, in terms of market data quality and the needed data for the consolidated tape endeavor. Second point for me on the SI regime would really be that we believe it would be better to box them really into large and scale transactions, make sure these vehicles are being used for what they were originally designed for. I think also the colleagues at the AFM had published an excellent study on this, showing that the average trade size in an SI in Europe is only about 37,000 euros, and with that, for most of the instruments, very, very far away from what could be considered a large institutional transaction. And I think moving on from there, we believe that it would also be important to sort of look again into some of the level playing field dimensions between alternative execution venues and the regulated markets and MTFs of this world. I would probably leave it at this for the first round, and then happily dive into some of the more nitty-gritty points in the second one.
One comment from reading the Financial Times, there I think is a trend for MTF business to also move to SIs and people giving back their licenses. So certainly the trend in Europe seems to go to more dark trading. Phil, you're maybe the judge out here, and I think you have a lot of academic papers that you've written on the European and US markets, so I think you understand market structure on both sides of the Atlantic very well. What are we doing right in Europe when it comes to lit versus dark? What are maybe lessons to be learned from the US? And maybe I think I just watched over the weekend Eat the Rich, the Netflix series on payment for order flow. Maybe you can also tell us a bit on what should Europe do? Ban payment for order flow, or basically make it the new default model for retail?
That's a pretty big question. Just listening to everything that is being talked about, though, I mean, it does have a lot of parallels with the debate that's happening in the US right now, where essentially the SEC is talking a lot about segmentation. They're not saying segmentation, but there is a lot of research on segmentation and the impact of that in the marketplace. And segmentation is different than fragmentation. Segmentation is your bilateral relationships. And what that allows you to do as a market maker is participate in spread crossing trades that are profitable and avoid spread crossing trades that are less profitable. And so one of the problems that we have, and it's kind of been touched on already with the level playing field, is exchanges globally have mostly been set up with one of the core principles being fair access, which means everybody has to make a quote to everybody, which means you can't segment. So what ends up happening when a marketplace can segment in one half but not in the other is the participants that can segment will participate with the less toxic, less informed, more retail flow and make money off the spread crossing orders there. But what that does is it leaves the flow that's actually coming onto the exchange, where those market makers are making the only prices that are being used as a benchmark to determine what best execution really is, with much more informed flow. And so they tend to see much stronger markouts, losses on their facilitation trades or their market making trades. And so you end up with a problem where the NBBO in our case is relatively informed, and it's kind of like the trade of last resort. You try and get an SI fill, and you try and get a fill in the dark on the near touch, and then the far touch, and then eventually you go to the exchange and you actually trade on the exchange. The market makers that are making the prices that all of those transactions rely on only get a trade at the very last instance. And so you sort of have this waterfall where the market maker that's making the right price for the market is the one that gets the last look at the spread crossing trade. And usually that means it's the most informed or the largest or the one with the most market impact. And so I think the SEC here has been talking a lot about whether the NBBO that we have is actually as good as it could be when there's a lot of segmentation in the US. So we have arguably about 40% of the flow is off exchange and internalized away from dark pools, maybe another 10% in dark pools. So you get close, at least during COVID, you got close to 50% of the market actually being off exchange, relying on those market maker quotes from the exchange, but not really paying anything for those quotes. And so you end up with a marketplace, and there's a lot of academic research that's been done, not just by me, that shows that if you do successfully segment less toxic flow into other marketplaces, into bilateral markets, that the quote itself gets more informed, is what the academics call it. If you're a market maker, that means it's more toxic. So you make losses on those trades. And eventually, if you make losses on those trades, you're going to have less volume and depth on the touch that's visible for an investor. And eventually, the spreads are going to get wider as well. And it's a little hard to really show the spreads are getting wider with all the volatility movement that we've had in the last 10 years. But we've done a couple of studies that seem to indicate that if you normalize for volatility, that actually spreads are starting in the US to drift wider. So there's a couple of academic papers that talk about tipping points where the market can get too dark. Some of them say 10 to 15% is too much dark. One of them says 50% is too much dark. And arguably in America, that's the level we're at, that 50% level. And we are starting to see the depth on liquid stocks is falling. And the spreads are actually starting to get wider after you adjust for volatility changes.
I mean, maybe to pose my question a little bit, Anuta, and also Alžbeta, referring from the discussions in council, I think there is a little bit the tendency to think, should we aim after the UK to liberalize more, to make dark trading, I think, more the standard model in the EU markets, to potentially allow for PFOF, sort of watching from the US, you would think, I understood you were alluding that you think that would widen spreads probably in the long term.
Yeah, if you can, I mean, it's just, sorry, I just looking at the relationship of informed flow versus not informed flow. I will stop.
But were you going to say something, Phil, or no?
Sorry, I can hear an echo. I thought it was somebody else talking.
No.
So 100%. If you think about the relationship of how PFOF allows you to create a relationship with a specific subset of the market, then you're actually saying, I want to trade with you exclusively, and that's the flow that I can make more money off as a spread crossing flow. And so PFOF does, just like having segments in dark pools, allow a participant, whether it's a market maker in the dark or an SI in the dark, to make sure that they can trade more with the less toxic flow, which kind of by definition leads the rest of the market with more toxic flow on exchange. And so the market makers that are making those EBBO quotes that everybody is relying on are getting paid nothing for sitting there providing the quotes, and they're actually not even capturing the spread until the liquidity inside the spread or in the dark pools has run out.
Professor Hübner, maybe as an economist, I think, are you discussing a little bit the market structure, payment for order flow? Because that's what I'm missing a bit in the debate, that we're very segmented discussing consolidated tape or PFOF. But I think in the US you have this linkage between best execution, consolidated tape, mandatory consumption, market structure. Is this a debate in the parliament?
Yeah, well, we had discussions so far on the proposal by myself, and we had the discussions on amendments, and then we are now starting the discussion on compromises. And not all the issues are there, but my understanding of what I hear from the colleagues from other political groups so far is that, especially on PFOF, if you ask me, this is going to be, when it will come to the decision, we keep it for the end of the negotiations. When it will come to the decision, this will be probably the most difficult discussion that we will have. And we continue to have basically these three options on the table. So to maintain the status quo, or to go for the total ban as the Commission has proposed, or to rather go towards a compromise that would seek to allow the PFOF, but only under certain conditions. This is actually what I proposed in my draft report, trying to in the compromises trying to move us forward. I think we clearly, there's agreement, like I think also in the Council, in the Parliament, and I understand everywhere that when you talk about the PFOF and what next step, we should look at it in the context of the best execution framework and how the best execution framework indeed work. I remember from my more than 40 meetings, I think, with the stakeholders that some of you were saying, don't touch best execution because it's absolutely perfect. And some were saying, do something with the best execution because it is so loosely worded in the MiFID level 1 that there are very different interpretations at national level. And to have the supervisory divergence of interpretations is something which I think we shouldn't have in Europe. So it's just strange that we continue with national supervisors with radically different position. And now we are looking also towards the solution. And of course, the tape, which is not a panacea for everything, but to a certain extent, it can be one of the elements that can help to ensure that the best execution framework can be improved. But then again, it should be rather a pre-trade tape that could be even more important in this context than a post-trade tape, because it could show a benchmark against which the brokers will be required to prove that the price at which they are executing was the right one. And I would be very happy to hear details from the Council, but I understand that both French and now Czech presidencies, they had some ideas, and let's hope that we will move in the same direction. Then you have all the studies, because there was no impact assessment by the Commission. So you have the studies which are absolutely clearly proving that the PFOF is detrimental for retail investors. Then you had recently, there was a study by the University of California, which is suggesting that there is practically, there is no worse, that PFOF venues do not cause worse execution for retail investors, but they offer them prices comparable to those. There are ESMA's comments as well that is saying that the PFOF can sometimes lead to brokers not acting actually in the best interest of their clients. So I personally believe, and I hope that I will take colleagues in this direction, that one way to solve the issue would be to assessing the best execution by comparing the execution price at PFOF venue against this benchmark, such as that one of the tape. But also, it is clear that disclosure rules for brokers should be strengthened, and I think, and this should be more transparent, and brokers should be required to provide clear and intelligible information to their clients. They should also probably be asked to make public aggregate information. So I think that we are basically moving in the direction that a PFOF can be allowed under certain conditions. So you can continue without PFOF if you are a broker, but you can move to PFOF, but then you have to meet those conditions. So that's actually where we are currently, and which way we will go, we will see. On lit, I don't know when you want me to say something on lit and dark, because that's also an important element also for us in the Parliament. So I'm ready to comment whenever you will see that I should say something.
Let's maybe go to the PFOF for a moment, and maybe first to Alisbeta and then to Niels again on the PFOF. I mean, if I look a little bit at it, if I read the last compromise proposal that the presidency put forward, I would say there's of course a lot of incentive for, well, if currently PFOF is a bit in the grey, I would say, it's a question whether it is permitted or not permitted. Actually, one commission official in a parliament hearing said a while ago that he thinks it's not permitted. Well, we're having now a debate to potentially allow PFOF. So if it would be written in the regulation, obviously it probably would become the default format. And we've heard from Phil that, you know, if you have more in the internalization model, in the segmented way, the toxicity of public exchanges, of public markets would increase. and probably spreads wouldn't widen. Equally, Danuta has said that much of this has never been through an impact assessment or scrutiny. Is that discussion happening a bit, how to actually get more evidence to be sure what we're doing, or is that sort of, what's the debate there at Council?
Yeah, the PFOF. I would like to echo actually Professor Hibner that we need to look outside the EU to see the practice, to see what is actually happening outside and inspire, but not to take over, and definitely not take over the wrong practice that might be considered to be happening in the US. So I would say that Council very much agrees that we would not like to have the US practice in Europe. That's definitely a starting point for all member states. Of course, when where we end up, that's a question. There is a requirement, and I think that it's also pretty much agreed that and the PFOF in a council, we're definitely building up on the best execution in Article 27 of MiFIR. So we are not trying to deviate from that practice, and we are definitely not trying to deviate from what is already in a MiFIR. So the interpretation there would hopefully stay the same, even though, of course, it would be further streamlined with further conditions that would be added. But as the Council is debating how to actually set further conditions for the PFOF if it is provided and used, it also says that if this better execution at the EBBO and the lower settlement cost is not able to be reached by the PFOF provider, then the order has to be set at a, let's say, lit venue. So there should be conditions making sure in the end that this would not be mainstream practice, or that we would not lead to the actually broadening the spread of EBBO. But of course, depending on where we land and how exactly the wording of PFOF would be, which we still do not have fixed because the debate is really ongoing, and there are member states who have invested a lot in this and have very strong opinions on the PFOF.
Niels, briefly comment on PFOF because you didn't mention that before.
I mean, I would always approach the debate from a perspective that Bernie Madoff was the one who invented PFOF, right? I think that's always important to remind people of. That's the guy who operated the biggest snowball system in financial history ever. Second observation I would make is that generally the conflict of interest seems extremely pronounced in PFOF, and I think clearly to Phil's point, exchanges do not operate such setups and are non-discriminatory in nature. By contrast, what we see here is, of course, that companies that have an own interest in proprietary trading are using PFOF also as a means to intermingle with the execution of customer flow. So generally speaking, and also sort of observing what has happened around GameStop, I think there is a profound need to look much more into the detail. Our perspective on PFOF is that a ban would be outright the best. I think the Netherlands has shown also that this works. Their market for retail investors in particular is pretty vivid in EU terms. But I think clearly if a ban will not be the way ahead, there must be much more transparency around PFOF payments. This must be publicly disclosed, not only to supervisory authorities, because I think the general public and especially end investors should have the ability to look into this. There must certainly be a means to enforce best execution also for PFOF. And I think it would be odd to provide sort of for a standard deviation formula that allows PFOF providers to not provide best execution. So these are my main observations on this. And I think, again, preference would clearly be with a ban. If a ban cannot be materialized, it should definitely be a meaningful setup which doesn't provide so many loopholes that essentially by the end of the day, the current PFOF practices just continue in the internal market.
Perfect. Professor Hübner, I understand, needs to leave a bit earlier from the panel, so let me give her the word first now, because we haven't really mentioned, you wanted to say something about lit versus dark, and also maybe you can give us an intro into the consolidated tape, which we thought we'd discuss towards the end of the panel. Is it the silver bullet that will solve the ills of the European structure? And Phil, is it going to be next?
Okay, thank you. So yes, I'm totally open. If anybody has a silver bullet, then MiFIR requires it, just demand it. I think on lit versus dark, this is a just issue which also is extremely difficult. My understanding has always been that the commission, when the commission prepared the review, they wanted to ensure that the share trading on lit venues in the union is approximately in line with ratios which we can see in other international financial centers. When I was then listening to FESE, NASDAQ, Deutsche Börse in my meetings, I understood you told me that there has been a market decline in the share of trading taking place on lit venues since the introduction of the first MiFID, which introduced competition to the capital market and among the venues, and that this is actually detrimental for the price formation. But then there were other stakeholders who were saying absolutely something different, that lit platforms have maintained the market share in the EU. So I looked to ESMA, and ESMA in its report is saying that there is no evidence that we have in Europe a problem with the way in which prices are formed in the markets of Europe. So I just think that it's a very difficult question. What is the right balance between dark and lit trading? And the only way we can approach it, I think, is to look carefully at how to calibrate all the rules which influence that balance. I think that's kind of imperfect maybe way, but the only way to go, and how they maintain, those rules will maintain the level playing field between market participants while avoiding the risk to price formation. And we discussed in the parliament, one idea is to increase pre-trade transparency by limiting the use of reference price waivers, which we are proposing higher thresholds to use it. And this should drive smaller orders to the lit venues. Then also there is this option which we propose of suspending and monitoring the so many times mentioned already cap mechanism, which is limiting dark trading under these waivers. And as these caps were set, we believe arbitrarily and proved to be of limited utility. And then we are proposing, unlike I think the council that is going to get rid, we have proposed initially the suspension of the cap that would reduce complexity and align the union with international practices. So to address the risk that the absence of caps will increase then the amount of trading in the dark, which is counterbalanced by higher limits on the use of RPW. So ESMA would be given the power to monitor and intervene when the proportion of dark would go too far. And so these two measures, we hope, the higher RPW and the suspension of caps and the role of ESMA, could strengthen the lit venues, but also make the regime more flexible and would give what is important for us in the Parliament, a greater role to the European supervisor, which is ESMA. So this is in very short how we see it. So trying to shape the rules that finally decide on this balance between the lit and dark. On the consolidated TEP, I think everybody has been already said. We agree in the Parliament, with small exception, how we should trigger the whole process. We are not yet with the decision, but we think that we have to. It's not only about the tape as such, but also how, with the whole structure of the regulation, how to use the chances that the existence of the consolidated tape is giving us. So in terms of the many choices for investors that are good from the competition maybe point of view, but there are market data fragmentation. So the tape is just aiming at this market data fragmentation, but there is also a lot of work on the data themselves to be done to make the consolidated tape really benefit from the data. Then we also know that when you have fragmented markets, it's difficult for investors to navigate through the markets. So that's why giving them the consolidated view is not a formality, because it's not only the prices, best bids and the offers, but it's also the information about available stocks, so you can make comparison across venue. Then we know in the European Union that we also suffer in the capital market from this, from the fragmentation alongside the national borders. And here again, the tape, if well done, can at least partly resolve this current home bias in trading. It could facilitate also the cross-border retail investors flow, which would be good then for many other things, many other objectives. And then I also think that what we have to admit is that the tape would benefit asset managers of smaller sizes, and also the funds which manage the money of European retailers, retail investors. And so it could bring direct benefit also to retail investors across Europe. But, and this would be the last sentence, I also think that the EU markets as a whole, including all participants to the markets, it would also benefit, because the tape could potentially increase the attractiveness and drive also more liquidity and more trading overall on to regulated markets. And it could also enhance visibility of venues that today are hidden because of the selection bias of investors. So I think that when we look at the consolidated tape, I would say that the question of the speed, how fast, which are also just, you remember we started some months ago, we had the discussions about end of the day, then we had 15 minutes, but now I think everybody who is just taking floor in the parliament is calling for a 1 minute delay. There are also many amendments on this, but then also there are those who need really real-time information to trade. For example, if you have in your shares the pension money, it's just slightly different situation. So I think taking into account that 15 minutes is already actually available, we should go probably to much more ambitious on timing of the tape. So the tape it's also an area which is not really already discussed and boring, but I think there is a lot of choices still to be made that can allow us to fully exploit the potential that the tape might give to this fragmented market of very diverse, different interests and different participants. So that would be probably my comment on the tape.
Thank you. Well, Phil, again, you're the judge out on Europe. You have a tape for many years. It's real time. It's pre-trade, national best bid offer. What are the lessons for us? Will it be the magic bullet that will help us to be liquid and grow as a equity trading center?
Well, I think given what processes we have in place here right now and all the debates we have, the answer is no. But what the tape does do really well is creates a virtual solution to the fragmentation problem. It does not do very well real-time data, if nothing else, just because of geographic latency. And that's one thing that we're learning in America, is that it doesn't even matter if you're all located in a small state of New Jersey, you still have speed advantages if you're sitting at the exchange where the trade is happening versus at the exchange where the quote is being collated versus somewhere else in the world that has to get it on a third leg. And so the speed argument, like getting anything to actual pre-trade, is impossible. When you look at how market makers set themselves up, they co-locate in exchanges so that they know exactly when their orders are acknowledged and when their cancels come back and when their fills come in, so that they have very fast information about what's going on in the exchange. Everything else is delayed. So even a direct feed to someone in Secaucus, which is where a lot of the dart pools are located, is delayed just because of the time it takes for the message to travel down to Secaucus. So the first problem that you have is you'll never solve the speed problem. And I think there's a point where the idea of the tape is to socialize the MBBO for investors, and most investors are eyeballs. they're retail investors. They're even broker dealers sitting on a desk with a Bloomberg or a Reuters screen, and they cannot react any faster than about a third of a millisecond. So to speed up faster than that means you're really starting to invest in solutions for sophisticated investors. And I would argue for those sophisticated investors, there is never a solution that's fast enough that sort of beats having proprietary feeds that they can do what they want with. The other problem that you have is with a segmented market, creating a socialized NBBO or EBBO, you've got to work out how to actually structure the economics. And I don't think we've done a very good job of that in the US. We started with a pretty cool idea, which is we're just going to have the top of book. It's going to collect revenue from everyone that wants to buy, and it's going to allocate it back to the people that are actually creating price discovery, whether that's quotes, which is 50% of the revenue handback, or it's trades, which is the other 50%. But what it doesn't do is account for the economics of segmentation. So by having a pretty cheap NBBO product, dart pools are actually able to use that and then effectively free ride off the prices of the whether it's market makers or an actual investor resting on the advertised quote. And so the people that are advertising quotes aren't actually doing the trades. A lot of dart pools get to actually benefit from being able to get pretty cheap data. You can, as a non-display vehicle in America, you can basically get a year's worth of all-you-can-eat data from the SIP for about $150,000. And these venues are doing trades worth billions of dollars. And so they effectively have a free ride off the price setting of the quotes from the market makers that are in the exchange advertised. But those market makers, again, are not capturing the spread for the value that they're receiving. So working out how much to actually accumulate, like how much that quote is worth, and maybe it's different for different participants. So in America, we do charge retail very differently than we charge professional eyeballs, which is different again than we charge the algorithmic, what we call non-display venues. But arguably still, and this comes back to one of the points raised, is like how do you structure it so that you make it more attractive to advertise quotes and then tighten that spread? And you don't create a problem where it's actually more attractive to start segmenting flow and trading off exchange using the quotes that are created on that SIP, which is relatively cheap.
So basically, the tape as a subsidy to investment bankers and market makers. Niels, is that what you would like to see from the tape in Europe? And what is the perfect tape that is a silver bullet?
No, I think it's a really important dimension and question to ask, right? I would always start with the observation, of course, that MiFID II, MiFIR, as currently implemented in the law, already has a consolidated tape in the text. Key question from our perspective is then, of course, to ask why no provider has emerged. And the clear reality on that end, and we can clearly out ourselves as one of the parties that has tried many years to establish a tape, is a problem around data quality, where the clear market failure sits. So if we want to approach some of the US investment banks operating large systemic internalizers, impossible to get their data, right? I mean, if these guys already fail in accurately reporting their data to the NCAs in the European Union, and the NCAs don't enforce the existing standards and the existing law, then we shouldn't sort of be surprised that there is no data available on these parts of the market, which is, of course, also interesting to observe, because that part of the market is intrinsically motivated because of conflicts of interest to remain intransparent. I think if we were to have data quality, and that's for me the important starting point, where I wholeheartedly support ESMA in being tasked to sort of define the standard quality, the standards going forward, and making sure the quality is there. I think that will be significantly superior to leaving it to an industry consortium, because I think that's pretty much how I sort of personally recollect the last 4 years, and that will not make a meaningful difference. I think then the second key point next to ensuring data quality is, of course, the coverage of the tape. We believe this should be 100% coverage of all of the EU market. That's the intention behind the tape. Otherwise, I can go to big market data vendors these days already and buy a tape, be it at Refinitiv or Bloomberg, where, of course, not 100% coverage of the EU market is being achieved, but a very large coverage already. I think 3-4 other elements for me are also critical in reminding everyone of, again, one is really make it cheap and fast to implement. We don't have the time now to spend another 5, 6, 7 years on a consolidated tape implementation, but it should be something that actually meaningfully supports Europe in this current challenge, also against the backdrop of the economic realities I mentioned in the beginning of our conversation. And that's also why I think in terms of concrete recommendations, we would suggest to definitely make sure that there is an appropriate sequencing. Right? We see this also in the deliberations on Council and EP side, where the added value as such should, of course, be much more meaningful on fixed income. Why so? Because the vast majority of the fixed income market remains intransparent. If we go for the outlook on an equities tape, then in particular, I think my main message is really avoid that pre-trade element. I think Phil has put forward quite a number of important illustrations as to what the US market has been suffering from structurally against the sort of backdrop of the pre-trade dimension. We shouldn't sort of be misled to assume that in Europe we could avoid gaming around the pre-trade tape. There will be much better informed investors and those that unfortunately are not that well informed, which of course leads to a strong discrimination between different market participants. But I would also clearly emphasize that in the absence of mandatory consumption, which is a clear integral element to the US tape, a pre-trade element in Europe would be disturbing to the extent that it would, by and large, create a question mark around how data contributors should actually be compensated for the contribution of data. That's why, concluding also on that end, my personal take is that starting with a 1-minute post-trade delay tape, including EBBO data, would actually be a meaningful starting point for Europe. This would be a tape that gives the ability to use it for quite a lot of different use cases, but in particular best execution verification. And I think once we have made our own European experience, or EU, I shall say, with such a tape, I think we can then also discuss next steps in terms of making it faster or expanding it into pre-trade if there is a need for that.
The one lesson I've already learned is that the next MiFIR panel will schedule for at least an hour and a half, because we're already 6 minutes over time. I would maybe give a final word to Alžbeta and then I'll sum up, because we're running late. I wanted to go into non-equity, but I think we'll skip that for this time. There'll be other opportunities to discuss that. Alžbeta.
Well, and there is so much to say on what was said here. Maybe one more remark on dark trading and lit trading. It was very, very well mentioned by Professor Hübner that, and we have put as a presidency on the table more market or more data-based proposal. ESMA has immense amount of data. You know it, you report it. It costs you a lot. So we believe in a council that we should finally get into the time where we actually use these data rather than make a decision on level 1 or at a table with a crystal ball, and decide to actually propose to have more regulation on dark trading based on the data, based on the assessment and the data that it provided. But the question is whether this is acceptable or whether there is a requirement for rather cap on level 1, which seems to be also advocated by a number of member states. But the same goes for the deferrals, the same goes for a number of other issues. We have immense amount of data, and I think it's time to actually start using them rather than make decisions without them. And a consolidated tape, this is really a very heavy debate to summarize in a couple of minutes, but I can completely agree, and member states also agree that the fixed income is something that really needs a tape at first. So the council proposal, and I think the sequencing is already pretty much agreed upon, is the first one to actually being selected. Equity tape and ETF tape. I would say this is exactly the moment when we are trying to learn from US, but not really follow US. EU tape should never be used for trading. It's not a tradable tape. It's only for information. So only for information purposes, also because there always will be a delay based on the fact that Europe is geographically spread and the markets are in various places. So it always be about information provided post-trade. Even if we include pre-trade, and the Council is not apparently going in that way because there is a strong opposition on pre-trade, it will always be ex post, not usable for trading rather than for information and estimation on where the market is, where the liquidity is. And even though it might have its advantages, it was not in a Council agreement that a pre-trade would be included. So far the Council believes that maybe some pre-trade information and very limited information in a post-trade tape might be beneficial also, as President of Better Finance said, for the retail to actually see what is the spread, what is the best European spread at the market, to compare the trade that has happened and that was executed compared to what was EBBO at the time. There is a lot to say on the tape, but I probably will stop here.
No, I think we could go on all afternoon. There's many facets, which I find interesting that 1 year after the file has been published, so many issues are still open and are still being discussed. I think we had a fantastic panel to discuss it. I think Professor Hübner, with many years of experience in the Parliament and in the Commission, you, Alžbeta, I think having a very difficult job trying to find compromise in Council. Phil, obviously adding the perspective from the US, and I think knowing both sides of the Atlantic from market structure and the tape very well, and I think Niels being an expert of the European regulatory environment. But for me, maybe that is really the sum. We need to find the linkages, and I think that's always the debate in the US. That's maybe the thing that I miss a bit in Europe. And for me, as an economist, market structure comes first. Market structure determines what is permitted and what is not permitted. Who can do what is the level playing field. And a tape or payment for order flow are always things that come in second. And the best execution regime is also something that needs to be somehow linked in this. And I think I would encourage lawmakers to especially think about those links, because I think missing links in evolutional history are always problematic, but I think in markets they can be catastrophic. And that's why I think we need to be sure to get this right, that the constitution of markets in Europe is right. So with that, thank you very much, and a hand of applause for a really great panel. Very interesting, and I could go on for an hour.
Thank you.